The Hedgeless Horseman here again, May 13th, 2022. Thought I'd just do a short follow-up video on my last video, just again to highlight that now is not the time to think about downside risk in terms of price, since the lower anything goes in price, the more you should start thinking about the upside. Especially if nothing bad has happened in terms of company fundamentals, and especially since a lot of junior has cash and it's very hard to go bankrupt if you don't have any debt, etc. And I thought I'd use a real life example. This is Bear Creek Mining, which is a, in one way a trading sardine that I have used. A lot of things have changed for the company. They're actually acquiring a mine, etc. So I'm not sure how much validity this will have in terms of a trading sardine anymore. But at the same time, since I think they're levering up to buy a miner or a producing asset. So in that case, it actually becomes, that's beta on top of beta. So maybe it actually will work fairly well as a trading sardine going forward. Anyway, for starters, like you can see, Bear Creek Mining is down here. Can you spot the times that it has traded below this? Here, after the worst bear market juniors probably have ever seen, at least in many decades, and here in the 2008-9 crash. So as I see it, if we think of this as a proxy for juniors, this is the potential downside in price, and this is the upside potential just to get to the next sentiment high. You see which box is bigger, I hope. Okay, and keep in mind that there are juniors, especially microcap juniors, that have are trading at equivalent level of where Bear Creek Mining is trading. Not far higher than the 2015 bottom, not far higher than the crash of 2008-2009. And a lot of them should probably be trading up here already. I mean, value, let's say, is somewhere around here. They're down here, or at least up here, something like that. Okay. Also keep in mind that gold instead of being down here in this area, which coincides with this bottom, it's way up here. So actually, yeah, I think a lot of gold juniors should actually be trading, let's say, 200% higher sort of fair value. Of course, when we go into a sentiment high, it will blow past that, like we see during this run up, and even here in Bear Creek Mining. Those are the main points. Okay. And right now, again, everybody's scared that it might drop here before it goes higher. I mean, this is, from a game theory perspective, this is quite easy. What's a loss? What's a permanent loss? What's risk? What's risk, in my opinion, is risk of a permanent loss. Buying something that is overvalued or will prove to be overvalued, that should go down and forever stay down. Risk to me is not price risk, where you might have a declining price for a period of time before it goes higher. That's not real risk. That's volatility. That's volatility. That's not risk. If the value of juniors were down here, then we have this in terms of risk. If value is up around here, this is upside, and this is the future expected return. So again, if you don't buy because you're afraid that price for a period of time might trade down here, can you explain that? That's akin to saying, I refuse to buy however good the opportunity is unless anyone can guarantee to me that this is the absolute price bottom. And if that's your condition to buy anything, that it cannot and will not fall any further in price before this, let's say, opportunity gap closes, then you'll never buy a stock in your life. Because any stock, no matter how good it is, can go down in price. Juniors can trade down below cash levels for a period of time. Back here, juniors barely had any cash levels. Right now, juniors have cash levels. So obviously, how that makes sense to anyone blows my mind, at least. That's why it's like if I were a subscriber to a newsletter, junior mining newsletter right now that wasn't bullish juniors, I would know, in my opinion, why said person is probably gonna sell newsletter in 20 years, because he or she has no idea about risk reward or what risk actually is. And again, let's take a live example. I started buying juniors around, I think, August here. Pretty much the same level that we are at right now, at least in terms of Bear Creek Mining. This is the chart right now for Bear Creek Mining since this sentiment high. Down 73.6%, trading at 98 cents. Okay, basically down, then pretty much has been flatlining around this level. Okay, here it actually flatlined a bit lower. This is that period. This period is this chart. Down 79%. Steady trend down. Grinding lower. Each passing day, people get more and more disgusted with juniors. They saw no evidence of, quote, being right, that it was cheap. Saw no evidence of being right by price going higher. So from September 2014 to end year of 2016, they saw no evidence that suggested that they were smart and the market was wrong. I'm just going to put this up. No evidence. The longer it takes, the lower it goes, the more people get inclined to sell. Because even if they started out buying here and thought, let's say, price was around this level, the more, quote, evidence they got from Mr. Market that no, price wasn't here. It was actually trending lower. They started to doubt themselves, especially down here where you have the longest time of the decline. Lowest price, biggest fall out of the decline. Nobody thought the juniors would ever recover again, because they just projected the trend forever going down, because they saw no evidence of it ever being able to go up more than this before going down. One recoil here, going down again. Saw no evidence of anything changing anytime soon. Well, what happened? One day the bottom was in, and it went from 50 cents and touched $4 within 8 months. long extended decline, grinding everybody and their mother out. When there was no evidence of this ever being able to muster up any sort of rally, it started rallying, and people thought this is going to be like last time. Then just kept going, and just kept going, and just kept going and going and going, and reclaimed this whole drop in 8 months. And what most people do is that they look at this and talk about opportunity cost, opportunity cost, opportunity cost. I should have bought X or Y. I should have been in tech. I should have been in cryptos. I should have been in yada yada yada. Because in their mind, a strategy is only working if share price, etc., goes like this. This is the dream stock. They buy, it goes up forever. Steady climb higher. And they think that's what you really want to see. No, because as price goes up, assuming not too much has changed in terms of value, that's like, looking at Nasdaq. Sure, it has done very well, but it's been way overextended, so that should go down and stay down. And many are down 50-60% or whatever, and many should be down much more. Some are down 70%. But in terms to make the most amount of money, you actually want something like this, where let's say this is the actual value, or value trend at least, and it just lingers and lingers and lingers, because that is basically saved up future returns. So a buy at this level will net you 100%. The lower it goes, the more you get your expected returns from any additional buy. And of course, this is by definition then becomes the cost of selling, what you're giving away if you sell. The lower it goes, your any additional buy will have increased future expected returns. And if you start buying here, sit through, I don't know how many percent this is, 1.8, yeah, like a 70% decline. If you keep buying, that means these buys down here is going to net you around 500%. This buy here, where you started off with, will still go down 70% before going up and netting you 100% return. That doesn't go anywhere. But if you sold at any point in time during this decline, you gave away an increasing amount of future returns, because you let the opportunity go to waste. That's why cost of selling is going up as price declines, and future expected returns are going up, which makes buying increasingly favorable, as well as holding, obviously. And one day the bottom will simply be in, because these levels were unsustainably low. And this was when the market was shit. This sector was shit. Now the sector is great, which makes many of these juniors, where they're trading at right now, makes much less sense. That's like if they were trading down here back in this time, given that here the sector was worthless and it was trading around this level. Now the sector is close to the best ever, especially the gold sector, and it's still down at these levels. So this opportunity in juniors right now blows this away, because gold wasn't as high, and especially blows away this bottom. If you can't buy this, never in your life will you buy this. Probably. Risks are way lower here than they're here. Here companies were close to bankruptcy. Here the sector is flush with cash. Here juniors are typically cashed up. Here juniors were running on fumes and needed to dilute at very low levels. Here many companies have just raised money. It might be a year before they need to dilute, and if they create some value from the money they've just raised, fair value is getting jacked up even more. So there is no way you'll get this slingshot if you cannot buy at times like this, or can't understand the fact that any further decline in price in a lot of juniors cases is a temporary thing. That's not risk. That is risk if you're stupid enough to sell. If you buy here, it goes there, you sell there. Congratulations, you just banked a, I don't know, let's say a 30% additional loss, lost out on, 500%. So in my opinion, we're way past the point of selling. This is just a matter of how good the additional buys will become. Because this, not particularly perhaps in Bear Creek Mining, because I don't know that company well, but juniors overall. At these levels they're trading now are great buys. And the buys can become even greater. That also means that selling becomes even worse. But 19 in 20 people will not see it this way. And they are not buying right now or even selling right now because they fear it can go lower. Back here they didn't have that fear. Back here when the upside was this big and the downside was down here, that's when they felt comfortable putting in money. Great past made them confident to buy. A bad past delivers great future returns. It's as simple as that. I'm bullish on my portfolio simply given where we are at right now. Back here I remember telling a friend it feels like I'm printing money. Stuff that put out no news just went up. And I remember around this top I owned Great Panther Silver or whatever it's called. I remember I had a spreadsheet basically trying to track valuations. And I remember Great Panther went up 10% a day, somewhere around here. Then it went up 10% the next day, and then 8% the next day. And I sold. I think I actually ticked that top to the day. It's simple. I mean, obviously, risk reward was already a factor. That's why I started buying miners down here, and why I sold Great Panther up here. Because that particular stock did not provide me with a great risk reward, because it just kept on going up, up, up without anything becoming better for the company. Price increased, while value did not really increase. Right now, in the junior sector, price has decreased substantially, while in many cases value has gone up. That is great risk reward. This was poor risk reward. This is great risk reward, kind of, even though there were also bankruptcy. Risks were high here. In many cases, risks are not high in juniors right now. So not only have you much lower risk profile right now than here, you have very low theoretical downside. Even in price, even for a limited period in time. They're getting extremely cheap. They're getting extremely extended to the downside. And one day it's going to turn into this. I don't know when it's going to come, but you would be happy if you started buying here and sat through all of this, because it would be worth your time. you would be up enough that you would beat an index by a mile through this whole period. And that's why you cannot look at your returns and just look in recent past from a sentiment top to a sentiment bottom and then start to project that, yeah, at this rate, I mean, if you're down 50%, well, I'm gonna be broke in whatever. Well, start to think how much you're gonna be up instead in 6 months, a year, 2, 3 years from now instead, because we're gonna get back to this level in sentiment. And when this bull really gets going, let's say the cup and handle breaks for gold, we're gonna go way higher. That's the main thing. It's like some gold juniors, as they are closing in on a enterprise value of 0, that means they're starting to price in a gold price of 0, a worthless business. So you can imagine how much margin of safety it is in the juniors right now. What gold price are juniors already pricing in? I don't know. Some cases 1400, 1300, 1200. We're at 1840 or 1820. So many of these juniors would need to see the price of gold go down like more than $400 before they are expensive today. So I don't know why anyone is looking at the price of gold right now and trying to figure out if they should buy juniors or not, when gold could go down to $100 tomorrow and they would still be cheap. Makes no sense. Absolutely no sense. And I know this is how people work, because I get affected by it as well. For some reason, we tend to get drawn into the panic of others who sell because they fear a declining price, not fear that they bought something that should go down and stay down. I mean, yesterday I bought a bunch of shares of a company, a microcapper that's cashed up. I think the enterprise value is around 4 million. Something like that. They have, I don't know how many projects they have. They have one project that I think in a hot market environment could easily be worth 5-6 times the entire market cap. And if they have some success, and the market gets hot, I could theoretically see it become like a 40 bagger or 50 bagger, etc. I mean, if we go up to the 2011 sentiment levels and they have success at that project, that, yeah, I mean, theoretically like 30 to 40, 50 bagger. That could basically pay for all your other shares going to 0. That's the kind of environment we're in right now. Nobody looks at what is under the hood of these juniors. Nobody thinks what is under the hood will be trading at in a good sentiment environment. Now you're literally able to steal stuff that will be valued multiples higher as the market gets more rational. And you can multiply that by some factor when we go into a frothy market. Our job is to buy and steal as much value as we possibly can, because one day that value will be priced in by the market when the market turns from a voting machine. Right now it's voting with their feet, panic, sell everything, no matter what the company has. When we reach the opposite end of that spectrum, they will be worth a lot more. And the higher they go, the more people will want to buy them. So that's what I'm thinking right now when I'm looking at some juniors. Okay, what are they worth? What are these projects worth? How do I think these assets will be valued in a high sentiment environment? Does it have scale? Because scale and blue sky is typically, I mean, I think it was around this period of time. You can remember Garibaldi Resources traded up to like 400 or 500 million in market cap before they had assets from their first hole. 400 to 500 million on really nothing but the prospect of a blue sky case, finding something worth billions of dollars. So nothing at that price, nothing at that time was valued at 400 to 500 million. Simply because when people get greedy, blue sky gets priced very high. And when people are fearful, blue sky potential gets totally priced out. So I prefer right now, for example, think of, okay, long runways. Which companies do I think will fetch a very high price when greed is rampant? Obviously the ones with big scale potential, large land package, etc. So that's what I'm thinking about. I'm not typically buying juniors that are very cheap but have more of a mediocre blue sky potential. No, I want the ones with huge blue sky potential. Even though it doesn't even really matter if we know if some of it will be materialized, because right now the juniors are all about potential. I mean, the earlier stage exploration plays, they are the ones that are killed the most because they almost only has potential. They only have potential. So when potential gets priced away, that's sentiment bottoms. That's the ones that people will pay the most for when we go into a sentiment high. That's why you will have the micro cappers from sentiment bottom to sentiment top. They will go up the most. Barrick, etc., which is much more about a mature company, not so much about potential for growth or anything like that. Not a drill hole play. They might go down 50%. They might go up 100, 200. Some of these microcap companies will go down 80% or even more, and they will go up like 500 to 1,000% to the next sentiment high. That's what we're front running. That was what I was front running when I bought Bear Creek Mining, because they had that was a big optionality play, and this is where we are at right now. I think you can see some kind of similarities. Yeah. Anyway, thanks for listening. As always, don't invest money you cannot afford to lose. You have to be willing to. You have to be able to stick it out. If you need money, if you buy here when future returns are very high, but you need that money at this point in time, so let you sell. So you were forced to give away an even better opportunity because you needed the money. So this is all about bear bottoms and crashes. This is all about staying power. All about staying power. Because you need to have the time to catch this. So if you need the money here, no good. If you're levered and you get stopped out or whatever, if we have an additional beep lower, that's no good. There's many ways to F this up, even if you know what you're doing. Leverage and needing of money, etc., are ways to mess it up. So even if you know that it's going to go here, if you're not part of that journey, it's worthless anyway. Yeah, thanks for listening. Not investing advice. Bye.